The prospect of increasing the 9% allocations, providing more disaster credits, and then reducing the bond test to 25%, depending on who's estimating, could add $8 billion more of deals to the market.
Welcome to Buzz House, a Baker Tilly podcast where you can find all the buzz around multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Garrett Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Each week, we'll bring you a guest or a topic in the multifamily housing industry that will help you win now and anticipate tomorrow. Let's get started. Our guest today in the Buzz House is Phillip Porter, a friend of ours and a great asset to the affordable housing industry. Phillip, you know I always love talking to you about structure and underwriting and things like that. So really glad to have Phillip in the Buzz House today. For those of you who don't know Phillip is a vice president for acquisitions at Enterprise Housing Credit Investments, LLC. Since joining Enterprise in 2001, Phillip has managed the investment over $3 billion in low-income housing and historic tax credit equity in 327 developments and over 25,300 affordable homes in 26 states. So just a wealth of experience. And again, I've enjoyed working with Phillip over the years. Just really quick before jumping into our discussion with Phillip, just have kind of two items we want to discuss from you from around the industry since the last time we talked. Garrett and I have talked about a number of states considering the state low-income housing tax credit or adding legislation around state low-income housing tax credits. And kind of very exciting, Arizona just passed new legislation for such a state credit. They're holding a hearing July 30th to get feedback from stakeholders around the implementation of this plan. It will most likely be used primarily in conjunction with tax-exempt bond projects as opposed to 9, but that's not 100% written in stone yet. The amount of state credits awarded per project will be equal to at least 50% of the federal amount. Really, the idea there is not a really small amount. It's sizable enough per deal that will be attractive for investors. The credit will be delivered over 10 years. As many of you know, some state credits have been 6 years. This will be a 10-year credit. There'll be $4 million per year to allocate for the next 4 years. We're going to be talking about it. I'll be at the Arizona conference on August 20th, speaking on the structure and use of the credit, and we'll let you know more as more comes out. Just the second kind of item, I think a lot of people are excited to see where this goes. In HUD news, the House Appropriations Committee approved fiscal year 2022 funding for HUD. The budget includes increases of $6.8 billion over fiscal year 2021, or about 12%. The big areas that, again, at least in this stage of the process, that show increases are $500 million in additional home funds, $1.2 billion in additional CDBG, $3.4 billion in additional tenant-based rental assistance, and actually $1 billion of which would be set aside for new vouchers. So really new vouchers, we really haven't seen that for quite some time. So we'll keep our eyes on this budget as it goes through the process as well. Now we have a lot of topics we want to get into with Phillip. So Garrett and I will jump into questions with Phillip. Garrett?
Yeah, thanks for coming on the podcast, Phillip. So before we get started with some questions, why don't you go ahead and start by letting our listeners know a little bit about your role at Enterprise and Enterprise's role in the industry.
Sure. Thank you, Garrick. And thank you, Don. I'm really pleased to be here today. So my role is as an originator at Enterprise in the Low-Income Housing Tax Credit Division, EHCI, Enterprise Housing Credit Investments. And so that role is basically matchmaking between investors and developers with their deals. And I cover various markets. Most of my time is spent on the West Coast, California, Oregon, and Washington. But I also cover the Mid-Atlantic and then certain legacy Midwestern states. We do follow sponsors wherever they go around the country, and that's why I've been able to work all across the country over the years with Enterprise. A little bit about Enterprise. We're a nonprofit intermediary focused on community development, and our mission is to make home and community places of pride, power, and belonging, and platforms for resilience and upward mobility for all. So that's really a broad goal. It's consistent with the original intent that Jim and Patty Rouse had when they created Enterprise about 40 years ago. But Enterprise has three major divisions: Solutions, which focuses on programmatic work to support affordable housing sponsors in major markets across the country. And they also do policy advocacy work with both tax policy and HUD budgets, et cetera. So there's a lot that Solutions does. The capital services that we provide are pretty broad. So we do permanent lending through Bellwether Enterprise. which does Fannie, Freddie, FHA, RD 538 debt, and they also lend against market rate and commercial properties. We have pre-development and acquisition funding. We do opportunity zone investment, new market tax credit work, also private equity. But the legacy service that we provide is low-income housing tax credit syndication, which is the part where I work. And then what is not as widely known is that we are a sponsor of tax credit and affordable and market rate deals. We have about 13,000 homes under ownership, and we property manage many of those. So, we're active in the development realm in the Mid-Atlantic as well. So I think that covers enterprise. Thank you.
Phillip, well, let's go ahead and start our discussion by looking back at the end of the year when the 4% tax credit percentage was fixed. We saw our developer clients, they were pushing forward with some deals, that wouldn't quite work before we got the lock. And then we also saw some private equity type market rate groups who are in the industry who are now penciling out a lot of 4% deals. And so from your perspective, what is the impact of this 4% rate been to the actual equity market? Are there any major concerns with deals that you're seeing?
Well, that's a good question, and I have a lot of things to say about this. Overall, big picture, the fixed 4% tax credit percentage makes bond deals stronger. So that's an unmitigated good. It fills gaps, takes the pressure off some of the soft debt providers at the state and local level. And one thing that developers may not value off the bat is that increasing the equity on bond deals makes capital account management easier. And we were struggling with a fair amount of that capital account problems after the last tax reform. So the fixed 4, structurally changed how bond deals work to the good. Now, there were some immediate challenges. First off, it was like great inflation. All the deals got bigger. And so the CRA budgets for investors, they committed to a number of deals and all of a sudden they're bigger. So they went through their capital budgets more quickly in a way that they hadn't planned. So that started to change how investors were making decisions about new investments because what they had planned to do got changed. Secondly, syndicators with multi-investor funds had deals that suddenly got bigger. And that created challenges for placing all that equity. And that took some time to work out. Most of those deals got sorted out in the first quarter of this year. Generally speaking, if the equity goes up on a deal from 3.07 to 4, then typically the price per credit will go down about 2 pennies. But there's a lot of variability in that because, for reasons that are probably not worth going into today. But generally, pricing kind of came down a little bit because suddenly there's more equity to place. And I'd say the big picture impact is the fixed 4 probably added $2 to $3 billion to roughly an $18 billion market. And I don't think that the tax credit industry has cleared that much in prior years. And so what was really happening last year was that folks were spending 2020's capital budgets as well as 2021's capital budgets and pre-spending capital budgets in a way that is starting to show up now in the market. So I think more will be revealed, but overall, it's a really good thing for deals and sponsors.
Yeah, thanks for that. I mean, Don and I certainly have seen the amount of deal growth, especially in states that don't really have volume cap issues. You see a lot more bond deals coming through here. And we did kind of notice a trickle down of the pricing on a lot of the transactions we were working on. So thanks for clarifying that. So Phil, in continuing with our discussion, we want to think through some of the legislative impacts to the equity market. So on Buzzhouse, we're always talking about the Affordable Housing Improvement Act and any potential increases in 9% credits, possibly effectively more bond deals because the discretionary boost they're talking about that is, applied to 9% to bond deals, but, maybe passing that legislation and also reducing the 50% test to 25%, which would hope also, in addition, alleviate that volume cap issue that we're seeing in a lot of states that are oversubscribed. So is the market ready for a significant increase in the amount of potential deals, given what you just said about a couple billion more dollars of equity need? What does the industry and developers need to be thinking about in terms of all the differences of the new bond deal laws or maybe new increases in 9% credits that might be coming down the pike?
Yeah. So just to revisit, I think the fixed 4 probably added $2 to $3 billion to an $18 billion market, making it 20 to 21 now. The prospect of increasing the 9% allocations, providing more disaster credits, and then reducing the bond test to 25% depending on who's estimating, could add $8 billion more of deals to the market, putting us closer to 30 billion than 20. It's unknown how the market will balance out. So there's some different things that can happen here. Tax rates are being considered for an increase, and that will naturally increase returns to investors. Economic investment returns are typically around 6.5%, and if tax rates go up 4% to say 25%, then that might add about 100 basis points to return. So once you're in the sevens, that's historically been attractive to insurance companies. I've heard that the GSEs, Fannie and Freddie, may have an increase in their targets for investment in affordable housing tax credits. And then I've also heard, now that the pandemic is beginning to resolve, although the Delta variant's a current concern, but some of the insurance companies that took a step back during the economic crisis of the pandemic I've heard, are considering making substantial commitments going forward. So I think there's some natural increase in commitments to the affordable housing space, and if tax rates go up, then that could motivate further commitments, but there could well be an adjustment to price. It all depends on the order in which the news is released, and it also, to some degree, is a function of CRA budgets and when CRA cycles end. So what would I recommend to developers? Number one, if more resources are coming out, that's a real opportunity for sponsors to create value for the community and for themselves. So, I think it's really important to maintain liquidity. Some folks have taken advantage of the low interest rates to do cash out refinances and resyndications of deals and built up cash. Some have put a fair amount of money into land, and that may be just the thing. But it's really important to stay flexible as a sponsor, because there may be a dip, just like the lumber prices spiked and now they're coming back down. There may be a dip in equity pricing that makes deals not work. And so you may be carrying deals longer before you can close them, or before the fresh resources from the federal government can be allocated to the deals in process. I would also suggest that sponsors focus on key investment partners. Many developers work with, one or more syndicators and maybe even one or more direct investors. I would focus generally on core partners and get in early to identify the right fit for equity placement, because in a limited capital budget environment, folks are going to be particularly careful about their commitments. They're going to be picking the best fit deals. Even if a deal is pretty good, they might prefer the best fit deal. So if you're in early and find the right fit for your deal, then you have a more reliable placement. I think that sponsors are getting the message, but it's really important to figure out your equity before your debt execution. There's a lot of lenders who are providing a lot of good service to developers, and some developers tend to pick the most efficient debt execution first and then seek equity only. That really limits the prospects for who would be interested in that deal, and you may give up a bunch of your borrowing in the form of lower equity raise. So I really would advise start with equity and work with the investor to structure the debt in a way that's consistent with that equity investor's needs to get the net raise that you're seeking. One other thing, I'm watching deals, have challenges because they haven't been able to move very fast. So I would say if you have a deal and it works pretty well, close it really quickly, because this is a turbulent environment. Anytime there's structural change, if you delay, or there is a delay in your deal, something might change in the external environment. Could be change in interest rates, could be change in equity pricing or demand, or you have additional construction cost issues. So, go for speed, and that's really what we're doing right now. We've staffed up at Enterprise, not as much as our volume has increased, but we really have, enhanced our capacity because we want to be able to respond to the opportunities that are presenting themselves already. But I expect to grow.
Very good, Phil. That was a lot of good information, and you're right. I mean, the timing we've just seen this past year, especially, deals are lagging, and we get what you're saying on just get it closed. There's too many variabilities, and time is money and cost and so forth. So, Philip, kind of switching, I got a couple maybe underwriting kind of related questions, and it's kind of even back to the first question, right? 4% deals are, we're penciling out deals, we're getting more equity in deals. But again, I think, Garrick and I'm sure you're seeing it too, Philip, is that, hey, it's a resyndication or it's a class B minus C apartment. And man, I just put in 4% credits. I put in debt at, great rates, 40-year amortization, and my deal works. But I've got 65 or 70% leverage or something. And I know, obviously we're getting feedback. I know there's no perfect answer, like what's too high of leverage. And I know, but what's the discussion about leverage? Is there really acceptable leverage? And back to your other point, hey, highest and best deal, right? It might be a good deal, but tell us a little bit about how your lens on looking at these deals and leverage.
Well, as a syndicator, Enterprise does a lot of 4% deals, and particularly my business is heavily weighted toward bond deals being focused on the coasts. But there's different kinds of bond deals and there's different levels of leverage. So let me speak about this a little bit more. What I would say is that overall, investors are most concerned about foreclosure risk. And the smaller the first mortgage, the smaller the deficits if economic issues arise or if Section 8 subsidy were to be diminished or go away. And it's the smaller the debt, the easier it is to limp along to year 15 when recapture goes away. So foreclosure risk being the primary focus, different investors have taken different approaches to managing that risk. And the problem with rules is that they can be kind of blunt instruments for managing pipeline. Some investors want to keep the perm debt, meaning the must-pay debt per unit, around $100,000 or less. And with 40-year amortization and the low rates and some of the higher AMIs on the coastal communities, you can have a regular 60% AMI tax credit deal with debt at $140,000 to $160,000 a unit. So it's very easy, or if there's subsidy, for the debt per unit to exceed that kind of standard. So that limits the decisions that investors need to make. They sort of let those deals go by. Now, many of those do fit into multi-investor funds, or some proprietary investors will pursue those higher leverage transactions. But the more economically motivated investors, and often those are insurance companies, they do manage funds on a leverage basis. So that's typically 25 to 35% of the TDC being perm debt. So yes, that ratio really affects the moderate rehab, low acquisition basis deals, because with the current borrowing capacity, you can very easily get into 65 to 75% debt, well, 65% with the current tax credit percentage. And so those can only be fit into multi-investor funds on a limited basis because we're trying to manage the overall fund to a certain ratio.
Phil, kind of continuing the discussion of underwriting, and I think obviously our industry as a whole has done a great job with underwriting, and I think relatively conservative, and we know these deals as a whole, we don't run into foreclosures and so forth very often. But as we've gone through the pandemic, and like you said, just variability all over the world right now, were there any changes or tightening of any of the underwriting? Right, we know there's a lot on just the flow of construction and costs, and will there be raw materials available? But you mentioned earlier, Philip, sponsor, liquidity, real estate owned. Are you running other sensitivities for lack of rent growth or expense? Just, I know there's a plethora, and again, you don't need to touch on all of them, but are there any you really focused on or tightened up a little bit during the last 12 or 18 months?
Yeah, the underwriting box that investors ask us to manage deals to has not materially changed since I got involved in the syndication business 20 years ago. But what has happened was when the supply of capital exceeds the flow of deals, the competitive pressure allows deals to get outside the box, right? Folks might stretch a little to make something happen. Once the pandemic hit, everyone was like, get back in the box, okay? Every deal needs to be in there. And so that's first step shown up in the form of operating reserves. 6 months OERDS, operating expense, replacement reserve, and debt service is the target. Rarely is that cut short. I think there was an increase in terms of focus on the sponsorship, their liquidity, their track record, how their portfolio is doing during the pandemic. Different deal types have been affected differently by the impact on the pandemic for folks' earned income. So folks that do a lot of 60% AMI or mixed income deals, I think saw greater delinquencies and greater challenges to cash flow as compared to the subsidized deals. Now, a few years ago, subsidized deals were looked at with more care because the concern is subsidy will go away. The pandemic's flipped that around. We still have to do the analysis of what happens if the subsidy goes away, but in fact, that's a positive today, more so than it has been forever. So it has changed what we're looking for. We do, depending on the investor, depending on the market and the deal, test what happens if AMI growth is zero for a period of time, 1 to 2 years, and then picks up. And really, it's just a sensitivity analysis, more or less. I think those are the key things I want to bring out. But I guess it's just back to the basics. It's all about real estate and sponsor strength.
It's interesting just hearing you say that because, you're probably right? It was more that it was going back into the box versus necessarily expanding, with even more requirements. It's just that you're right. It was getting a little lack before because of the disparity there with how much equity and how much deals are there in the competition. So interesting point. I think Don and I have definitely felt some moving back into the box with a lot of deals over the past year. So I also want to talk about, this is sort of getting out of underwriting, but similar to, in the same vein, I guess, and is income averaging, right? So obviously we had this new election on the 8609. And so as we wait to see if this IRS is going to have any updates on this topic, can you let our listeners know where the equity market's position is with respect to income averaging in their projects? I know there's a lot of discussions that go back and forth and, different types of percentage people want to see in these deals. Are there any circumstances where you can include average income in a deal?
Well, first off, income averaging is certainly a positive policy opportunity. It really allows renovation of properties where folks' incomes have gone up to, for those communities not to be destabilized through permanent relocation. It allows for social engineering through mixed income properties going forward. And so I think there's a lot of real benefits that are attractive to communities and states who are allocating resources. However, the initial response on the compliance has created a lot of concern for investors, and that's why we're having this conversation right now. Initially, I think folks were open to it. Some were very much open to it. Others were like, heck no, we'll just wait and let all this shake out for a while. So first off, there were a few investors who said, no, thank you. But many were like, yes, tell me why it makes sense in a given deal. And that's where typically folks were looking for some discount to the 60% limit. So if the average income for all the units in the property has to be at 60%, if a lot of the deals early on were being underwritten to 58 or 57% average AMI, but increasingly as some of the hearings and some of the discussions with IRS by attorneys for investors and the industry have gone on, it's just really not clear whether there's catastrophic compliance risk or just incremental compliance risk associated with if the deal goes above 60% average income. And so during this year, during 2021, multiple major investors in the market have changed their tune and decided not to pursue income averaging. And so some of the proprietary channels are closed, but still there are some who will allow it. Those who will allow it are typically pushing average AMIs further down. Deals that I don't think we're doing any at 57 to 58. It's generally 55 or lower. And the deals that have been getting through the process with more ease are typically 50% average income against the 60% max. And you'd say, why? Why would you do income averaging? Well, usually there's Section 8 subsidy on the very low income units, and there's a lot of very low income units, and those deals aren't carrying too much leverage on the 70s and 80s. But in order to get that approved, you have to have a very strong sponsor, very strong property manager. There will be ongoing compliance review paid for by the deal or the sponsor on the side if necessary. And that will only let up when the rules are simplified and the risk is lower. I'd say if you're a sponsor, you really need a clear reason to pursue that strategy because there are going to be costs associated with it. And if the IRS maintains a more conservative interpretation and you were to go out of compliance, it could be a major recapture cost to you as a sponsor over time. So I think a lot of folks are getting out of that. The other thing, just this is important for the market to understand, single investor funds, those investors can choose to make that investment or not under different terms. But in the multi-investor world, it's really about the lowest common denominator. So if there's an anchor investor in the fund who doesn't want income averaging, then you can't put any in the fund, period. So syndicators are really trying to figure out how to structure funds to accommodate a few deals that they are committed to doing for one reason or another. But there really is very limited demand. And For some reason, Enterprise was early in California pushing back on income averaging, and we've closed a couple deals in the last 3 months where we had the sponsor unwind their income averaging commitment. But I think increasingly the developers will hear from syndicators that they cannot place the income averaging deal. So just be aware that that may be a moving target.
Yeah, we really, really appreciate the clarity on that, Phil. I'm sure our listeners do as well. So one last question before we wrap up. I know Don mentioned in the intro, there's more states that are either looking at passing or have passed state low-income housing tax credits. So given that more states are considering this, are there best practices for including the state investor in the projects from your view, or do these state investors tend to do all the federal, or tend to let the federal investor dictate all the underwriting, or are there any considerations developers should be thinking about, whenever they're introducing state credit investors to their projects?
So state credits are a wonderful resource for affordable housing. It comes in the form of equity typically into the transaction, which sets the deal up for resyndication and reinvestment in 15 years. For-profit sponsors, particularly like equity versus debt. So it's really a good thing. There are a variety of challenges associated with state credit placement, however. As a predominantly federal credit syndicator, we fold in state credits whenever we can or syndicate them with our federal investor as often as possible because there are always tax considerations associated with a side-by-side investor arrangement with a state credit buyer versus a federal credit buyer. And I think that developers should really go deep to understand how, if they're working with a state credit syndicator, how that organization is structured and what that means for the tax impacts of either certificating or allocating the credits to the state syndicator. It's really something that's a little more complicated to figure out on a deal-by-deal basis, but the market does it all the time, and it's really a good thing for deals. And I would just suggest that to the extent states can be flexible, certain states allow for refundability and basically will give the developer cash for the credits back. That's a pretty surefire way to get the deal done. Some states allow for the credits to be certificated, meaning allocated to the general partner who sells them as an intangible asset, raises cash, and then they bring that cash into the deal. Certification is also a preferred execution for a number of federal investors as they try to manage the more volatile state tax liabilities that they face. I think the overall issue is that the state tax bills are very different than the federal tax bills for investors. They're more volatile. Sometimes they're much smaller. And so it's harder for federal investors to manage that in a way that is consistent with the way we handle the federal credit. In general, start with your federal investor, see what they can do, and then fold in the state credit syndicator in consultation with the federal investor and get your lawyers focused on the details.
Well, that makes a lot of sense. Just a wealth of information, very much. Phillip, thank you very much for joining us in the Buzz House today. And listeners, thank you for tuning in. Thank you for listening to Buzz House. To receive a notification when new episodes are available, please subscribe to Buzz House, a Baker Tilly podcast, wherever you get your podcasts. For additional resources around multifamily housing, check out bakertilly.com. And if you have a suggested topic, please send them to build@bakertilly.com. That's BUILD@bakertilly.com.